A lot of investor favorite growth stocks seem to be rolling over after getting hammered the last few months. This includes Sea Limited or SE stock. Investors are wondering what's going to happen from here. Why has it been hammered so much so recently? We're going to talk about this as well as the upside potential, what investors are sort of playing for over time, and what does Sea even do? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did own shares in Sea Limited stock. So a little context on my own personal history with Sea. I started buying in 2019 between $30 and $40 a share. Then I called out to Unrivaled Investing Journey subscribers last year, as Sea was raising money, as the stock had gone up 10x, I was saying, you know what, this was nice. This has been a good ride. But I also called out, I was selling somewhere between $250 and let's say $350 a share, in between those prices. And so, it was a nice run, but I saw that the valuation got quite expensive. Then, since then, the stock has gone down quite significantly, and investors are wondering, well, wait a second, what's going on? This was almost a $400 stock. Now it's, trading around $100. What's going on? Why this drawdown? So let's understand, what do they do? First, Garena, their digital entertainment segment. This is the most downloaded mobile game globally. We're talking about Free Fire. That's the game that sort of drives Garena segment. They have a whole bunch of other games, but Free Fire is the dominant one. Free Fire is also the highest grossing mobile game in Southeast Asia and Latin America. And so this is a battle royale game, primarily played on the mobile, with 77 million quarterly paying users and an incredibly lucrative business, 600 million plus in adjusted EBITDA. Now, they also have some other segments. This isn't just a gaming business. You also see that they have Shopee. Shopee is their e-commerce marketplace, predominantly focused on Southeast Asia, where they're a top contender in many countries with dominant market share positions. That said, they do have global aspirations with bets all over the world, including Brazil, India, France, and Poland. Some of these bets haven't worked out. We'll talk about some of that in a minute. Their third segment is this digital financial services segment. This is their smallest but fastest growing segment, called Sea Money is really the product under Digital Financial Services, or DFS. This complements their e-commerce marketplaces by providing a digital wallet and other credit products to small consumers and merchants. So merchants that are looking to transact easily online, hey, you might need some sort of financial product. And what you're tapping into, why are investors buying into Sea? What you're really tapping into is a mega tailwind, a long-term secular tailwind. As you look at Southeast Asia, you look at the e-commerce penetration, amount of retail e-commerce sales, and you say, wow, this is single digits. This could be much, much, much higher over time. And so you're looking at a nice secular tailwind. And if you have the dominant marketplace, we know from marketplace dynamics that it gets harder to compete if you're the top marketplace, because you have the most shoppers and then you have the most merchants. So then it goes, well, why would I try to compete with a new marketplace offering? And so you can have over time incredibly lucrative economics for mature marketplaces. That said, they're far from that, which we'll talk about in a second. But this is what investors are playing for, a multi-year, potential multi-decade tailwind. And you see across this business, you're seeing nice growth. Their bookings business has been a bit slower. We'll talk about that dynamic in a second. But their e-commerce business, 90% revenue growth, and their digital financial services, or Sea Money, 700% revenue growth last year in the fourth quarter. This is just incredible what you're seeing. The problem, or the challenge, is that despite all the profitability that you see in this, dark blue, this is their digital entertainment, you see even more being invested in their business, in Shopee, in e-commerce, in their digital financial services. So they are still extremely unprofitable business. And so this is part of the reason why the stock's been going down. Look, all, growth stocks that have been unprofitable, they've been getting haircutted lately because folks are saying, well, interest rates are going up. That's going to affect the valuation for these unprofitable businesses. So you have this aspect where you see that they have burnt a lot of cash flow, and investors are saying, when is that inflection point that you're going to potentially get to, financing your own operations without having to either use your balance sheet or tap on other investors? That this is making investors a little more nervous. It increases the risk premium for a company like Shopee. Another core aspect why a company like Sea, another core aspect why Sea has gotten hit is because of their outlook for 2022. So you could see, they're posting incredible outlook for Shopee and for C-Money, saying 155% growth, 75% growth, in terms of their outlooks for these businesses. But they didn't say what the percentage growth is for their digital entertainment business, saying, look, we're expecting around $3 billion in bookings. And the reason why is because they're expecting a sizable contraction based on around 4.6 billion in bookings in 2021. This implies around a 35% decline. I don't like it when management, doesn't call it out up front. I'm not happy that they did this with their presentation. Like, look, if you have a problem, call it out. And so clearly 35% decline for their only profitable segment is a challenge. So what's going on? Why is it happening? So you have a couple of key aspects going on. One is that their Free Fire app was blocked inside of India, partly because of an association of being a Chinese-owned company. The reality is they're not Chinese-owned company, but Tencent has historically owned a large stake in Sea, and so that you get this sort of penalty by association there. Management has also seen weakness in global user engagement following economic reopenings. People are going back outside saying, hey, I'm not locked in having to play Free Fire all day. I'm not going to spend as much on it. And so if people are going out and about, you are going to see a pullback in terms of how much people are going to spend on digital entertainment. So this is potentially a very big deal given the huge cash burn outside of Garena, outside of what they generate with Free Fire. And this is also what's getting investors nervous. Now, I got to give management a lot of credit here. They raised billions of dollars at smart prices last year to carry themselves to their inflection point of self-financing. They internally estimate this, and they've called this out, saying, hey, based on looking at our e-commerce, our Shopee and C-Money, businesses, they think will be at an inflection point of self-financing their growth initiatives by 2025. Now, that is a lot of time, and that means, investors might say, hey, we're skeptical of this business. Let's apply a greater and greater haircut until we see that inflection point where they're profitable. So that is a key aspect to think about. That said, they did raise a lot of cash to handle it, and management has been pulling back from some of their global aspirations. You've seen several articles over the last few months pulling back from Europe, exiting France, pulling out of India. They had a Shopee in India. So they're I think, strategically saying, hey, we want to balance our cash with smart bets and what actually resonates. And, they're pulling out of Europe, pulling out of India so far. So then the question is, where does the stock go from here? Where does C stock go when you're looking at really choppy waters? First, a quick plug. If you're interested in finding potential multi-baggers, or you'd like to follow along with my personal financial journey, go to unrivaledinvesting.com, click Join the Journey, where I write a weekly letter. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. Once again, that's unrivaledinvesting.com. Click Join the Journey. And so as I consider the current setup with C, you're currently looking at a business that's around a $70 billion market cap. So let's sort of peel out what we're looking at with Garena. And with Garena, management's penciling out around $3 billion in bookings, next year in 2022. I'm going to give it a somewhat of a wide range of -30 to -40. Historically had really nice profitability of, mid 50s to 60% profitability. So I'm saying 55 to 60%, assume a 15% tax rate. And so that gets you, let's say around $1.3 to $1.6 billion in core profitability from this Garena segment. The question is, do they get back to growing? Are they flat, or do they, continue to decline from here? This is a huge question that you're going to be looking at. But based on that, assuming, 5 years out, and what sort of end multiple does that sort of get? Because arguably, if a business is declining in the years ahead, you should have a much, much lower multiple. Whereas if you're growing, maybe you should get a much higher multiple for that future growth. So I'm assuming a range of possibilities from -5 to +5, 8 times earnings multiple to 15 times multiple. You could argue maybe I'm being too aggressive to assume get back to growth when you're seeing such a huge decline. Or maybe you say I'm being too conservative by assuming it perpetually declines going forward. Either way, I'm getting a Garena valuation somewhere between $8 billion and let's say $30 billion. So against this current market cap of around $70 billion, that implies Shopee and their C-Money, or their financial services, their digital financial services, is valued somewhere between, let's say, $40 and $60 billion. And so then the question is that appropriate? Is that too cheap? You're looking at these two segments combined, management expect to generate around $10 billion. So you're effectively trading at 4 to 6 times sales. Is that too cheap for very fast growing businesses? The challenge here And this is clearly I think there's opportunity here. I'm going to discuss this in greater detail, with Journey subscribers, trying to, sharpen my pencil a bit, sharing the thoughts and potential upside with, looking at these individual segments like Shopee and their financial segments. Clearly, I think there's a lot of upside from here, but going into the details of what the potential is, I'm going, look, there's only so much you can do on a YouTube video, and I don't want to go over time here, but, you could see here that looking at their different segments, that they still have a lot of execution that they need to do and need to prove, because, you're looking at their e-commerce and sale of goods, and, you're effectively looking at really, really low margins, margins below 20% gross margins, below 10% on their direct sales for their marketplace. And so looking at this makes you think, oh, okay, if you're going to value this at a high multiple, like if you see a software business that's at 4 to 6 times sales, that might arguably be very cheap because their gross margins are at 90%. But when you have an e-commerce marketplace where their gross margins are only at 10 to 20%, they have a huge amount of execution risk. They need to prove themselves. And I'd argue that's one of the core risks here, is that you need to see them actually, can they get to that 2025 inflection point where they prove the economics in their e-commerce segments? And that is really what's going to be the driver of this business. You do have the secular tailwinds, with Southeast Asia. I do personally own the stock, but, in terms of when do I double it and that type of thing, I'm going to need to sharpen the pencil a bit more, talk about it with the Unrivaled Investing Nation, Unrivaled Investing Journey subscribers. And but you could see the risk here, the execution concern around their margins being so low. And, once again, you see this 1.5 billion in e-commerce and other services in the fourth quarter versus 1.2 plus billion in cost of sales. So you're looking at, sub 20% gross margins, and that is going to get you a much lower lower multiple than looking at the traditional, let's say, SaaS company that might trade at 6 times sales, but has a 70, 80% plus gross margin. It's a very different risk profile that I would call out. So if you've enjoyed this video, providing an overview of why the stock has been getting hammered in rough waters, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.